It is Wednesday, March 27th, 2019. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing in the individual charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. This month, I'd like to highlight some of the key messages outlined in the materials posted at the matasii.com site regarding our triannual update on global risk. As such, I'd like to discuss the areas shown here. Let's begin by looking at the current global risk situation and reviewing some of our recent posts on our top tipping points for 2019. We are currently following 44, all available at matasii.com. Our top tipping point for 2019 is the expectations for a major long-term economic and market risk reversal due to primarily the end of the debt supercycle. What we are seeing, and as should be fully expected, is the central banks and powers to be are trying everything in their powers to stop this natural adjustment within a capitalist system from occurring. As such, we have just witnessed yet another historic and unprecedented monetary reversal by the global central banks. When the global markets began to decline significantly in the fall of Q4 2018, the central banks again stepped in. They have done this in a significant way and across the board. The markets have reacted as you would fully expect when more money is chasing the same number or possibly less number of opportunities. The question is, how long will they continue to do this, and will the longer-term reaction by the markets be what we have witnessed since the advent of QE-like monetary policies or programs by the major global central banks? It all started with China in late November when they injected over $1 trillion in liquidity. The thing to watch will be how China's economy responds going forward. In today's global interconnected trade world, it is basically as goes China, so goes the world. Our number 2 tipping point is the financial markets themselves and their correlation to historical valuations. The forecast of historical measures and predictive indicators are all much lower than the S&P 500's annualized real total return of about 6%, going back to 1964 through last year. Shiller's PE 10 predicts a 2.6 annualized real total return. Buffett's market value over GDP says minus 2%. Tobin's Q ratio indicates minus 0.5%. Jones's composite says minus 4.1%. The markets are aligning with tipping point number 1, that a major market reversal lies ahead. With both Democratic and Republican leaders now calling for taxation changes regarding corporate stock buybacks, this, along with other tax law changes, may be the initial catalyst for a long overdue correction. Remember, the popular tax provision passed by the Republicans in 2017, which allows business to fully and immediately deduct their expenses, phases out after 2022. Our number 5 2019 tipping point is an EU banking crisis, which we've been posting more and more on as we see more and more evidence of this occurring. In the euro area, shaky banks survive because they are kept afloat with national tax injections or via opaque network of rescue institutions such as the EFSF, the ANFA, the EFSM, and the ESM. I don't think many people even know what those acronyms stand for, but they mysteriously work behind the scenes. The ECB's asset purchases and the Target 2 payment system have turned out to be a quasi-unconditional credit system. Around €1 trillion have been handed out via Target 2 to ailing southern European banks with gradually eased collateral requirements. The upshot is that the ECB's monetary policy and financial supervision leave the euro area banks unprepared for an upcoming economic downswing, already actually occurring in Europe itself. Shrinking interest margins and high regulatory costs are driving many small banks into mergers. In Germany, the number of banks has fallen by 12% since 2008. Failing banks are taken over by more solid competitors, usually with the help of politicians. Witness the current merger talks of Germany's two largest banks, Deutsche Bank and Commerzbank. Something serious is occurring when something like this occurs. Bad bank loans, capital outflows out of Europe, and progressive zombifications of EU banks and corporations are only some of the areas we've been posting on, which we don't have time to get into here. There are many geopolitical situations that we lay out in this month's Global Risk Report. The one we must mention is Brexit itself. When Britons voted on June 23, 2016 on whether or not to leave the EU, there was no discussions of a hard or soft Brexit. These terms were invented after Brexit passed by a surprisingly large margin, and the mostly anti-Brexit Tory party government, especially its leadership, decided that it needed to negotiate the terms of leaving. Brexit supporters regard such terms as betraying the 2016 Brexit referendum itself. These 17.4 million Britons undoubtedly believe that Brexit would mean exactly that. Britain would no longer be governed by any EU laws, regulations, etc. Nevertheless, all that the world has heard since the day in June 2016 is a debate over the terms of leaving, with any so-called terms being labeled as soft Brexit and leaving without any agreement as hard Brexit. In a hard Brexit, Britain just leaves and all EU regulations are null and void. It's pretty clear-cut. A soft Brexit can mean almost anything that is not a hard Brexit, i.e. Britain would agree to continue some or all of the manufacturing regulations, tariffs, intergovernmental agreements, such as ceding jurisdiction to the European Court of Justice that apply to EU countries. The list is almost endless and the time frame very nebulous, a perfect playground for those who wish to have a Brexit in name only. If there is to be a Brexit of any sort, however, Parliament must act. Experts in British constitutional law claim that only Parliament can actually take Britain out of the EU, and only Parliament can decide under what terms, if any, it will do so. Of course, one of the terms of separation could be that there are no terms of separation, thus a hard Brexit. There are serious issues concerning the effects of imports, the effect of British exports, the effect on the City of London, the effect on controlling borders. The effect of a hard Brexit on Britain itself should be overwhelmingly positive, especially if Britain does in fact remove all tariffs and conclude free trade pacts with the rest of the world fairly quickly. Another geopolitical tipping point also concerns Europe, and that is Italy. Italy is in the process of massive political turmoil, conflicts with EU governance, and serious banking problems. Bad bank debts of 185 billion euros were reported in Italy at the end of 2017, a record for the European Union. Italy also accounts for roughly a quarter of non-performing loans in the Eurozone, i.e. loans that are not being repaid or are seriously overdue. And it is easy to see why Brussels considers the country to be the EU's weak spot. The worst hit by Italian banking problems will be French banks, which Bloomberg estimates have Italian loans worth hundreds and hundreds of billions of euros on their balance sheets. Such a shock could see foreign investors, and many European ones, beginning to flee the Eurozone, adding a currency component to the banking crisis. Time will tell whether the European Commission is willing to take such risk to punish Italy's freedom-loving politicians. Populist politicians in Europe love comparing the European Union to the late USSR, and this comparison is starting to ring true like never before. The more the Commission tries to bring Rome into line, the wider the spreads on Italian bonds tend to grow, which in turn forces Italian banks to cut their lending. The risks deepening Italy's economic slowdown, which would put even further strains on Italy's fragile banking system. And this is the last thing that France's government or banks want. Let's shift gears to the MATA-SII Global Risk Assessment by those institutions and others shown across the top of this slide. The Economics Global GDP Tracker has been downgraded to its lowest pace since the financial crisis, with world economic growth slumping to 2.1% on a quarterly basis. That's down from 4% in the middle of last year. According to economists, the risk is that the downward momentum will be self-sustaining. The cyclical upswing that took hold of the global economy in mid-2017 was never going to last. Even so, the extent of the slowdown since late last year has surprised many economists, including Bloomberg, who actually do the global GDP tracker. The OECD joined the IMF in slashing its 2019 growth forecast, cutting its projection for aggregate global growth to just 1%. Just over half of its previous outlook of 1.8%. as more central banks opt to retreat into the safety of stimulus, or at least back off their hawkish rhetoric, we'll see if disaster can be averted once again. Even the World Trade Organization, which we have traditionally not followed in our global risk assessment until recently, are listing the following indicators, some of which we have not seen before, as serious concerns: merchandise trade volumes, export orders, international air freight, container port throughput, automobile production and sales, electronic components, and agricultural raw materials, all of which we've added to our tracking mechanism at MATA-SII. The World Economic Forum at Davos suggested we need to seriously be worrying about weather and natural disasters now. Natural disasters are becoming globally more and more common occurrences, not previously as frequent and as massive. At least that is my observations. The economic impact is often profound, unplanned, and financially destabilizing. Separately, at the annual meeting of the American Economic Association, the IMF warned in the starkest terms yet about an upcoming global recession, and that the leaders of the world's largest countries are dangerously unprepared for the consequences of a serious global slowdown. The IMF's chief concern: much of the ammunition to fight a slowdown has been exhausted, and governments will find it hard to use fiscal or monetary measures to offset the next recession, while a system of cross-border support mechanisms, such as central bank swap lines, has been undermined. Let's run through our geopolitical risk areas, which we traditionally group into three categories: tensions and conflicts, social, economic, and financial, and global governments. These are all exploded further on the MATA site, so we'll just pick an important one from each of the groups. The South China Sea conflict is getting worse by the day. The Secretary of State's visit to the Philippines after the North Korean summit in Vietnam saw Mike Pompeo strongly warn China that any armed attack by China on a Philippine ship or plane in the South China Sea will be treated as an attack on American ship or plane, bringing a U.S. military response. He also said China's island building and military activities in the South China Sea threaten Philippine sovereignty, security, and therefore economic livelihood, as well as that of the United States. As the South China Sea is part of the Pacific, any armed attack on Philippine forces, aircraft, or public vessels in the South China Sea will trigger mutual defense obligations under Article 4 of the Mutual Defense Treaty. Why make such a statement? For years, Beijing has claimed as national territory virtually the entire South China Sea. Vietnam, Malaysia, Singapore, Taiwan, and the Philippines all reject China's claim to the Paracel and Spratly Islands within that sea, but Beijing has occupied and expanded half a dozen islets, landed planes and troops, and fortified them as military and naval bases. Pompeo's declaration amounts to a U.S. war guarantee. Meanwhile, in parallel, the U.S. seized an island in the South China Sea for apparent training for war with China. How would you expect the Chinese to react to this? As additionally, the chairman of the Joint Chiefs of Staff, Marine Corps General Joseph Dunford, told the Senate Armed Services Committee, and I quote, "It is critical for us to be able to project power in the context of China, and one of the traditional missions of the Marine Corps is seizing advanced bases. If you look at the island chains and so forth in the Pacific as platforms from which we can project power, that would be an historical mission for the Marine Corps, one that is very relevant to a China scenario," unquote. Here are just some of the headlines we have read since our last report that strongly indicate the world is actually rapidly undertaking massive military buildups in a raft of hotspots, not just Russia, China, the U.S., but many of the countries affected by these particular global powers. From a social, economic, and political perspective, we are seeing evidence of what the end of the debt supercycle likely portends. How would you describe the social mood of the nation and the world? Anti-establishment, anti-status quo, anti-globalization, choking on fast-rising debt, stagnant growth, stagnant wages, rising wealth and income equality, rising disunity, political polarization. These are all characteristics of the long-wave social economic cycle that is entering the disintegrative or winter phase. You see souring social mood, loss of purchasing power, stagnating wages, rising inequality, devaluing currencies, rising debt, political polarization, and elite disunity. These are all manifestations of this phase of history, which has been painstakingly assembled by Fisher and Turchin. We can therefore anticipate ever higher prices for food, energy, and water, ever larger government deficits, which end in bankruptcy, repudiation of debt, new issues of currencies, rising property and violent crime and illegitimacy, rising interest rates until very recently this was considered impossible, rising income equality in favor of capital over labor, continued debasement of the currency, rising volatility of prices, rising political unrest and turmoil. And there you have our future. Visible in the 13th, 16th, and 18th century price revolution waves which preceded ours. With this list of manifestations in hand, we can practically write the global headlines for 2019 through 2025 in advance. Finally, the third of our geopolitical signals is global governance. The World Economic Forum is worried that the world won't be able to nimbly cooperate and respond to threats if something isn't done about the increasingly state-centered politics, that is, growing populism and nationalism. To quote them in their annual Global Risk Report presented at Davos in January, and I quote, "Is the world sleepwalking into a crisis? Global risks are intensifying, but the collective will to tackle them appears to be lacking. Instead, divisions are hardening. The world's move into a new phase of strongly state-centered politics, noted in last year's Global Risk Report, continued throughout 2018. The idea of taking back control, whether domestically from political rivals or externally from multilateral or supranational organizations, resonates across many countries and many issues. The energy now expanded on consolidating or recovering national control risks weakening collective responses to emerging global challenges. We are drifting deeper into global problems from which we struggle to extricate ourselves. If another global crisis were to hit, would the necessary levels of cooperation and support be forthcoming? Probably, but the tension between the globalization of the world economy and the growing nationalism of world politics is a deepening risk." End of quote. In searching for anything to blame for the rise of populism, that is, aside from policy decisions dictated by increasingly out-of-date elites, the report hits on the growing occurrence of mental illness around the world, though they bypass the drivers of the social changes that the world economic researchers believe are at the root of this problem. In my opinion, the driver behind much of the growth in populism, nationalism, mass migrations, and much of the societal unrest is inequality, recently made worse by failed monetary policies to stem the end of the debt supercycle. All of the above shows in the updated MATA-SII global aggregated risk level, which has deteriorated over the last 5 months from 8.1 to 8.4. At 8.4, we are well above levels last seen during the EU banking crisis and have been above that level since the EU and UK credit default swaps began rising during the run-up to the UK Brexit. You can see the reversal here in the MATA-SII tracking of global credit default swap changes. There is lots to worry about, any of which could trigger major financial market reactions quickly, abruptly, and deeply. As we show in this month's mailing, we are particularly concerned from an overall situational analysis perspective at the highest levels of an emerging new Cold War, that growing populism will lead to socialist leaders and that slowing global trade and the impact to de-dollarization is going to be significant and enduring. So in closing, as I always remind you, remember the answer will be that they will simply print more money, and they will continue to do this. It is the only answer politicians actually ever agree on. Until that is, no one wants the money or trusts it. That's when the crisis occurred. But we're still a long ways from that. So while they're trapped, invest accordingly. I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2019 turn out to be an outstanding investment year for you and your family. I sincerely thank you for listening.